Very good morning, friends. Well, I would be taking the topic today with you that is Accounting Standard 4, and this is meant for CA Intermediate Group 2 Advanced Accounting subject. And I am CA Kapileshwar Bhalla, and today we're going to discuss some inputs about AS4 contingencies and events occurring after the balance sheet date. Well, my approach on any accounting standard is always that I first look at the nomenclature of the standard. Well, I think even if I don't know anything about this is one thing which you can get a feel after reading the name of the standard is that there are two issues which are discussed in this is. One is contingency, and the second issue is events occurring after the balance sheet date. So the question arises, what is contingency? And the question rises, what are events occurring after the balance sheet date? Though from an examination point of view, the focus in terms of AS4 is majorly in terms of events occurring after the balance sheet date. But of course, we'll have a little inputs in terms of contingencies as well. Let me, I think, first of all, give you a little brief in terms of what is contingencies, and then I think we'll focus on events occurring after the balance sheet date. Now, hear me very carefully. When there is a contingency, that contingency would lead to creating a provision. Don't worry, I'll give you some notes also, but I think first let's get some focus point on the concept. So when there is a contingency, the contingency would lead to, you can say, a provision. It could be a provision for a liability, or it could be a provision against an asset. Mind each and every word of what I'm saying. Like for example, if you say that I am creating a provision for doubtful debts, then it is a provision against an asset. But say, for example, you want to create a provision, let's say a provision for a warranty, then it is a provision which is a provision for a liability. So, what do we need to see? If you're looking at a contingency, that would lead to creating a provision, and that provision could be a provision against an asset or it is a provision for a liability. So, but there is already an accounting standard which deals with the concept of creating a provision for a liability. You're absolutely correct. And that is Accounting Standard 29. So when you're creating a provision for a liability, get the chain correct, there is a contingency which leads to a creation of a provision for a liability. Accounting Standard 4 is not applicable. In that particular case, we apply Accounting Standard 29. But when you're creating a provision for an asset, like for example, a provision for doubtful debts, then Accounting Standard 4 would become applicable. But not all provisions against assets are covered by AS4. Let me also caution you that. Like for example, if you're looking at a provision for depreciation, which is also a provision against asset, that is covered by Accounting Standard 10, not AS4. So what is the model of this story? I think let me pin this down as well. So we've decided something very important. I said when you look at the word contingency, I said when you look at the word contingencies would mean that there is a need to create a provision. Get the chain very clear. So when there is a contingency, the contingency means there is a need to create a provision. The provisions could be created. The provisions could be created against assets. The provisions could be created against assets, or it may be a provision for a liability. So we said that if it is a provision for a liability, a contingency resulting in a provision for a liability, I said we're going to apply Accounting Standard 29, not AS4. Now, if it is a provision against asset, then it all depends. It depends upon what type of provision are you talking. For example, if you say it is a provision, let's say for a doubtful debts, then it is accounting standard 4. But if you say, for example, there is a provision for a depreciation, then it is supposed to be accounting standard 10. And there could be more examples also. I think if I give you a little technical example, when you create a provision for impairment, now you would say, so what is impairment? I think that's the reason I was avoiding giving that example. But if you say that there is a provision for impairment, which is a provision against an asset, then accounting standard 28 applies. So what is the model of the story? That when you look at accounting standard 4, my mind tells me a contingency would result in a provision. Is it a provision against asset? Then certain circumstances AS4 could apply, and typically there is only one circumstance where AS4 would apply when you were to create a provision for doubtful debts. But if it is supposed to be a case of provision for liability or other provisions against asset, then other Ind-AS, other accounting standards would apply. So I, generally tend to sound Ind-AS because I'm also, in my blood Ind-AS because of teaching at the fine levels. So I sometimes, interchangeably use the word AS and Ind-AS, so don't mind. But of course, the numbers are different. So for a liability, we're looking at AS 29, and if it is a provision against asset other than doubtful debts, it could be other AS. That is the reason the focus in terms of contingencies is not much in the exam. So I would also prefer to discuss only this aspect in terms of contingency. I'm not even getting into, what is a definition of contingency. I've just given you a very basic brief on the concept of contingency. So my main thrust in terms of accounting standard 4 is going to be on events occurring after the balance sheet date. So I think let's focus on the word. It says events occurring after the balance sheet date. Okay, let's do one thing. To explain you what is events occurring after the balance sheet date, let's take a small little time scale and explain something to you. Then I'm going to take you to the definition given in the accounting standard. Imagine that this is the financial year, and imagine this dotted line is represented by something else. Let's say this is 1st April 2019 and this is March 2020, which is supposed to be the balance sheet date. And let's say I've given you a date, it is 30th September 2020, and this is what we call the date of approval of financial statements. This is what we call date of approval of financial statements. Now, hear me very carefully. I think I want you to first look at the name of the standard. It says events occurring after. The word is very clear, events occurring after the balance sheet date. Now, I think one thing is very clear. I am looking at events occurring after this date. So when I say it's events occurring after the balance sheet date, then we are saying that the events have to occur, between a certain cut of dates. So, but it says events after the balance sheet date, but you've given a stop in terms of 30th September. When we're going to read the definition in terms of accounting standard 4, that what is events occurring after the balance sheet date, your very first step is that you will identify, did the event take place between the two cut-off dates? I am going to develop a 3-step procedure with the help of which you will be able to zero down whether it's an event after the balance sheet date, and is it something what we call adjusting or non-adjusting. Let me give you a background. When an event takes place after the balance sheet date, per se, anybody would say, so balance sheet is made as on a particular date. If the balance sheet is made as on a particular date, I am not concerned with events which takes place after the balance sheet date. Why should I account for those events which took place after the balance sheet date? Because balance sheet is as on. But accounting standard 4 tells us that there are certain events which require adjustment to the financial statements on March 20. And there are certain events which would not require adjustments but would only require disclosure. So that means the events which take place after the balance sheet date and up to the date of approval of financial statements could be categorized into two kinds of events. One is events which would require adjustments to the financial statements, which means I would land up adjusting the assets, the liabilities, the incomes, and the expense. Or there might be events which would not lead to any adjustments, but these events are something which will only be disclosed. These events are which are only going to be disclosed, and the disclosure is not in the notes to accounts. The most common misconception people have is that events which are not to be adjusted are to be disclosed in terms of notes to accounts. No, it is disclosed in director's report. The disclosure in the notes to accounts is done in the international accounting, not in this IGAP. Accounting standards are called IGAPs. So accounting standard 4, focuses on that you need to see that which events which are taking place between the two cut-off dates. Are they adjusting events or are they non-adjusting events? Which means, do we adjust the financial statements or they simply become a subject of disclosure in the director's report? So I think now what I'm going to do, I'm going to read the definition with you and I'm going to develop a three-step criteria with the help of which you will easily decide is it adjusting or non-adjusting. If you listen to the next 10-15 minutes carefully, trust me, you're going to get a good hang in terms of accounting standard 4. Once you get the concept, then it is simply, making a little practice in terms of doing a few case studies and developing the concept. I think it is always important that you first develop your conceptual base. After you develop your conceptual base, then it is a little extra practice in terms of applying the concept. So let's do one thing. Let's, I think, take you to the standard and let's have a look at the definition which is given for events occurring after the balance sheet date. So don't worry, the notes will come later. With this definition, I am going to give you a three-step procedure. Step 1, step 2, step 3, on the basis of which we will decide. Let me read the definition in para number 3. Events occurring after the balance sheet date are those significant events. Well, I don't think so. I need to overemphasize the word significant event. That means not all events which occur after the balance sheet date are significant. But from the examination point of view, I don't need to really decide is it significant or not. Trust me, all the questions which will be given in the exams, those events will all be significant in nature. You don't need to take a call to decide is it significant or not. Both favorable and unfavorable. Now, what is important is that when you see an event occurring after the balance sheet date, the impact of the event on the financial statements might be favorable or unfavorable. It could lead to increasing the profits of the entity. It's favorable. It could lead to enhancing the assets of the company. It's favorable. Or it could lead to, an unfavorable situation as well. So which means that the events can be good or the events can be bad. That means the impact on the financial statements might be favorable or unfavorable. Now, what is the key important thing is they occur between the balance sheet date and the date when financial statements are approved by board of directors in case of company and by corresponding approving authority in case of any other entity. In a partnership firm, the approving authority is the partners. In every company form of organization, the financial statements are, approved by the board of directors. And in case of any other entity, a non-company, it could be the approving authority. So the very first thing you got to ask yourself in the question is, did the event take place between the cut-off dates? Trust me, many a times examiner has tested our knowledge on the front that he gives you an event which takes place after the approval date. So if there is an event which takes place after the approval date, then it is not even an event after the balance sheet date. So the first thing you're going to do in every question is very religiously, you're going to first of all see, is the event taking place between the two cutoff dates? So once you zero down that yes, the event took place between the two cutoff dates, you go to the step number 2. Now what is the step number 2 and 3 we'll develop. Let's read further. Examples will come later, but I think first I need to get a larger concept and then I'll relate these steps to the examples also. Two types of events can be identified. Those which provide further evidence of conditions. Further evidence of conditions that existed on the balance sheet date. Now, the second thing which you need to ask yourself is there a condition which existed on the balance sheet date? So what do you mean by that there is a condition which existed on the balance sheet date? Don't worry, I'll come to that. But we need to first, get a list of the questions also. So we need to look at the second question, that is there a condition which existed on the balance sheet date? And then the third question is, did I get a further evidence in the cutoff dates? I think let's take an example. I think we'll understand a little better. So let's take a small little example and let's take the same dates and give you something. Let us say in the same example, an event occurred, let's say on 10th of April. Let's say on 10th of April, one of my debtor became insolvent. Let's say one of my debtor is declared insolvent, so nothing is recoverable from him. Now let me go step by step and hear this very carefully. Step number 1. Did the event of insolvency take place between the cutoff dates? Yes, sir. The event took place on 10th April, which is between 31st March and 30th September. Good. Let's go to the step number 2. Was there a condition on the balance sheet date? A debtor would not have become insolvent suddenly. There must have been some conditions which would have triggered his insolvency. Mind the words what I'm saying. I'm saying there must have been some conditions which might have triggered the insolvency. So what do you mean by that there are some conditions which triggered the insolvency? Let's say for example, there was a fire in the premises of the customer before the balance sheet date. So let's say if there was a fire in his premises before the balance sheet date, I knew that the fire was so major that he might become insolvent. So the fire triggered the event that he became insolvent. So what is the condition on the balance sheet date? The fire which could lead to the fact that he could become insolvent, and you finally got evidence of the fact that he is declared insolvent. So we need to basically see that what triggered his insolvency. Get my point very clear. You need to basically see what triggered his insolvency. You don't become insolvent in a day. There must have been some conditions which would have triggered the insolvency. So as I said, the fire took place before the balance sheet date, and in which case, the customer has become insolvent. So we got a further evidence related to the condition which existed on the balance sheet date. I know what you're thinking. You're sort of ask me, sir, if the fire takes place after the balance sheet date and he becomes insolvent after the balance sheet date, then is there a condition on the balance sheet date? Of course not. Because the condition which triggered the insolvency was not present on the balance sheet date. So if it is not present on the balance sheet date, then it cannot be adjusting. Then it is simply a non-adjusting event. So you need to basically, evaluate that if there is a condition which was present on the balance sheet date and the confirmation of that took place with the evidence coming in the cutoff dates, then it is adjusting in nature. But if the conditions arose subsequently after the balance sheet date, then it cannot be adjusting event in nature. So can you give more example? I'll give you another interesting example, a little technical one, but I think that is a very interesting example which will give you a further inputs on the concept. A little technical one, so hear me a little carefully. Let's take the same time scale. Let us say before the balance sheet date, I issued a check to my creditor. I issued a check to a creditor. So this is a check which was issued before the balance sheet date. So when I issued a check to the creditor, I did the entry creditor's account debit to bank. So I did the entry creditor's account debit to bank. So when I issued a check to the creditor, I reduced my creditors, I reduced my bank balance. Now let's say between the two cut-off dates, the check got dishonored. This creditor went to the bank, and when he went to the bank, he presented the check and the check got dishonored. And the reason for dishonor is that there is a wrong signature on the check. The reason for the dishonor is that there is a wrong signature on the check. Now, as an auditor, I am thinking that if the check is got dishonored, should I go in for a reversal entry? Should I say that since the check is got dishonored, let me again increase my bank balance, let me adjust my bank balance, and let me increase my creditors again? Should I consider this to be an adjusting event and adjust the creditors and the bank balance in the balance sheet? Don't start thinking vague. Think on a chronological order. Think on the three-step procedure which I am trying to give you. Don't worry, we'll document that procedure after some time. So in step number one, you asked yourself, did the event take place between the two cut-off dates? Yes, sir. The check got dishonored between the two cut-off dates. So the event took place between the two cut-off dates. Great. Then we go to the condition, the step number two. Is there a condition which existed on the balance sheet date? Some of you would think, condition on the balance sheet date, how can I say that there was a condition? What do you need to think now carefully? What triggered the event? Hear this very carefully. What triggered the event? What triggered the dishonor? It is the wrong signature which triggered the dishonor. You need to ask yourself that was the wrong signature present on the balance sheet date? Did the wrong signature exist on the balance sheet date? Yes, sir. The wrong signature existed on the balance sheet date, of course. That means the wrong signature was existing on the balance sheet date, therefore the check got dishonored. So it is the wrong signature which triggered the dishonor. The condition was there on the balance sheet date. So, but we never knew that there is a wrong signature. That is not even relevant. The standard says very clearly that there is a condition which existed on the balance sheet date. The knowledge of the condition is not important. It is not important that I knew that there is a wrong signature. I got evidence that the signatures are incorrect when the check got dishonored. So if I go with the concept that is the condition which existed on the balance sheet date, yes, there is a condition which existed on the balance sheet date. Did I get a further evidence related to that condition? Yes, the dishonor is the further evidence. So all three steps are answered in a yes. And that means it is adjusting event. Sometimes on a lighter side, when I'm teaching accounting standard 4, what comes to my mind is, in a particular religion, a marriage takes place, according to the fact when the Qazi tells the person, Kabul hai, and Kabul hai. When he says a yes on a three times, then we say it is adjusting event. It is supposed to be, marriage takes place, but then technically it is called an adjusting event. So the moral of the story in terms of accounting standard 4 is to zero down whether the event is adjusting or non-adjusting. You need to follow a three-step procedure very religiously. And what is the three-step procedure? Number one, Did the event take place between the two cut-off dates? No, sir, or yes, sir. If the answer is no, AS4 is not applicable. If the answer is a yes, then we go to step number two. And in step number two, you need to put across, is there a condition which existed on the balance sheet date? What do you mean by condition? Condition means what triggers the event. The wrong signature triggered the dishonor. The fire in the premises of the debtor triggered his insolvency. So you need to see that the condition was present on the balance sheet date. The knowledge of that condition is irrelevant in nature. And if there is a condition which existed on the balance sheet date, you go to the step number three. And if there is no condition on the balance sheet date, but the conditions arose subsequently, then in that particular case, you would consider it to be non-adjusting. Now, what is the step number three? In terms of step number three, you need to consider, did we get a further evidence in the cut-off dates? Remember, the further evidence has to come in the cut-off dates. So if you get a further evidence related to that condition, so you are getting evidence related to that condition in the cut-off dates. If yes, it is adjusting. If no, it is non-adjusting. So we've understood largely the process, but I think one or two small little examples would make it more clear. Yes, I think let's do one thing. Let's first document this to you, and then I think we'll take you to one of the examination questions, which will give you a complete insight of how the three-step procedure is allowed. And trust me, this is the main part of this accounting standard. There is a little more things to be discussed, but right now I am only focusing on a three-step procedure with you. So we can now consider, first of all, a documentation of the steps, and let's give you a three-step procedure in terms of the step. So what are you going to do on a step-by-step basis? Number one, you go to the step number one. And what do you do in terms of step number one? Did the event take place? Did the event take place between the two cutoff dates? Between the two cutoff dates. So we need to see, did the event take place between the two cutoff dates? And this is going to be pretty simple. I don't see any challenge in terms of step number one. You just need to see that the date of the event is falling in the cutoff dates. If the answer is no, then accounting standard 4 is not applicable. The end of the game. Trust me. There was an examination question, where they gave you an event after the approval date. That is not AS4. And if you say a yes, baby steps, go to the step number two. Don't be in a hurry. You need to go on a step-by-step basis, and trust me, you would never go wrong. So we go to the step number two. Once you've identified that the event took place between the two cut-off dates, we go to the step number two. Now, what do we do in step number two? Is there a condition? Is there a condition which existed? Is there a condition which existed on balance sheet date? Is there a condition which existed on the balance sheet date? So you need to put across a question, was there a condition which existed on the balance sheet date? Now, what is the condition? Remember, every time you're looking at a question, you need to see the condition which triggers the event. The condition which triggers the event. So as I'm going to do another one or two questions with you after the steps are done, you will be able to get a complete grasp on the step number two. So is there a condition? Condition means which triggers the event which existed on the balance sheet date. And also remember, existence does not mean we may not have knowledge. It is not the knowledge which is important. As I said, wrong signature. The condition must be present. The knowledge of that is not relevant. As an entity, I never knew. As an entity, I never knew that the signature was incorrect, but the signature was incorrect is a matter of fact. So the condition was already present on the balance sheet date. So in this case, again, you would answer that did the condition exist? Yes. Or the answer is no. The conditions did not exist. So if the conditions are not present, I presume that those conditions arose subsequently. So I'm assuming that if the conditions were not present on the balance sheet date, maybe they arose subsequently. So if they arose subsequently, it is a non-adjusting event. It is a non-adjusting event, which would mean a disclosure in director's report. Now, these are small little mistakes, we sometimes make. We land up saying disclosure in notes to accounts. No, disclosure in director's report. And if you say, yes, there is a condition, then go to step number 3. Then let's go to the step number 3. And finally, the step number 3, we are going to ask another question to ourselves. And what is that question going to be? Did we get a further evidence? Did we get further evidence? It is like proof of the fact. So, you can say the condition is like the fact and you get evidence of the fact. So like the signature is incorrect is a fact. You get a dishonor, it's a evidence of the fact. Mind the words. So did we get further evidence related to conditions in cutoff dates? So we should be getting an evidence in the cutoff dates relating to the conditions which existed on the balance sheet date. So we may get a further evidence or we may not get a further evidence. So if we got a further evidence, yes, then it is adjusting event. And if the answer is a no, it is supposed to be a non-adjusting event. Super. So we've understood a 3-step procedure, and I think we need to apply this to a simple little case study, which is an examination question. I think that's going to give us a good level of confidence as well if we can crack on those particular questions. Let's, I think, take you to a question. I am carrying a few questions, collection of questions with me, and I am going to take you to one very interesting question which came in the exams in May 2013, 7 years back. But I think it's a pretty good question. Not question number 4, not this one. I think it's November 13, not this one. Yes, November 13. I'm looking at the question number 5. Now, please hear me very carefully, and I'm going to apply the 3-step procedures in terms of taking a decision. One thing which I've not told you so far, I'm going to tell you in this question. I've given you a 3-step procedure, but there is something more important which I'm going to tell you in this question. State with reasons how the following events will be dealt in the financial statements of Pradeep Limited for the year ended March 30. An agreement to sell a land to another company is entered on 1st March before the balance sheet date. The value of the land is 20 lakhs in the balance sheet. However, the sale deed is registered on 15th April after the balance sheet date. Now, what is the event which I am looking in this question? In the first example, the sale deed getting registered is the event. Now, we need to understand that if you got a sale deed registered, should I make adjustments of this in the financial statements? That means I record the sale of the land, remove the land from the balance sheet, recognize the profit or loss on a sale. If yes, then it is adjusting, or we simply make it a disclosure and we don't adjust the land in the balance sheet, then it would be non-adjusting. Now, before I go to the 3 steps, let me first of all tell you something. When you look at the word adjust, or when you look at the word non-adjust, what do you adjust? There has to be something which you need to adjust. Are you getting my point? There has to be something which you will adjust, which means there must be a recognized item in the financial statements which I need to adjust. So you mean to say that if there is nothing which is recognized in the financials, then there cannot be adjusting event? Yes, I am saying that. If you notice in the first part of the question, he very clearly says, and if you notice the date, the value of the land in the balance sheet is 20 lakhs on March 2012. It's not a misprint. We're looking at the balance sheet on March 13, and he's giving you that the land is already in the previous balance sheet. There is already a recognized asset in the balance sheet. So when you say that I will adjust, the first thing is also that you need to zero down that there is something which is already recognized in the financial statements. So now let me ask those three questions. I am not given in the question what is the date of approval, so I presume that the event took place between the cutoff dates. Number two, is there a condition on the balance sheet date? So there is an agreement to sell. That agreement to sell will trigger the sale deed getting registered. So there is a condition on the balance sheet date which triggered the sale deed getting registered, which is also a further evidence. You got the trail in the three steps. Event took place in the cutoff dates, condition on the balance sheet date, and the further evidence in terms of sale deed getting registered. It is an adjusting event. So which means that you're going to record the sale of the land and book a profit or loss on sale? Yes. And there is a profit on sale to the extent of 10 lakh, and that's a favorable event. And AS4 does not stop me from recording that gain because it says event can be favorable or unfavorable in nature. Let's try the next example with you. It says negotiation with another company for acquisition started on 2nd February before the balance sheet date. And Pradeep invested 40 lakhs on 12th April after the balance sheet date. The first thing you need to ask yourself, is the investment appearing in the balance sheet? No. Is there a recognized asset in the balance sheet? No. Many people always look at this question and say, sir, there is a condition which is present on the balance sheet date. There is a negotiation. Agreed. So there is a further evidence that you made an investment. Agreed. So all three steps are met. Agreed. But what is not agreed is there is no recognized item in terms of asset, liability, income, and expense. Since there is no recognized item, what do you adjust? Oh, so indirectly after this example, what we're trying to understand is something like this, that you should first of all see that is there a recognized item in the financial statements? Yes. And then you should apply this three-step procedure. So, but then you didn't give that explicitly in the three-step procedure. You should have given us a four-step procedure. Well, I intentionally didn't give you that because this is one key issue which you need to look at every question. First, you need to see, is there a recognized item? If it is no, it cannot be a case of adjusting or non-adjusting. But you know why I didn't give you this also? Because there is a little divided opinion in terms of things. But I think I don't want to get into controversies on that. So you first look into, is there a recognized item? If yes, apply the three-step procedure. Is it between the cutoff dates? Is there a condition on the balance sheet date? Am I getting a further evidence related to them in the cutoff dates? Yes, yes, yes. Kabul hai, kabul hai, kabul hai. It becomes an adjusting event. And you know the flow chart is already given to you. Now it is just a matter of applying, this particular concept to few more questions with you, and then you would be able to get a good grasp on the accounting standard 4. But there is a little more in terms of things which I would be coming again with you, related to the concept of dividends, related to the concept in terms of a going concern, and we could take up some more case studies based on that. Today my agenda was only to give you the larger concept in terms of how to decide is it adjusting or non adjusting in nature. Thank you for watching. Take care and goodbye.